But people got to remember, dividends are a tax inefficient way of getting money. Doesn't mean you shouldn't get it. Mo, why is it tax inefficient? Everyone loves dividend investing. Why? Because it's money coming in. It can never be taken away. It's not like a stock that goes from 40 to 50. It can go back to 40. It can go lower. When you get that dividend check, you can live off of it. It's in your account. It ain't going anywhere. People love it. So guys, if you're new to the channel, please subscribe. We are value investors. We have a different way of looking at the market. We don't just say we're value investors. We actually walk the walk, okay? It's easy to talk the talk. I have a lot of friends who say they're value investors and they love Amazon at $100. Okay. I don't understand that. Now, when it comes to dividend investing, I don't know the exact study, but something I remember reading, like if you only invested in dividend companies going back to 1928, you would have beaten the market by like 2 or 3%. But people got to remember, dividends are a tax inefficient way of getting money. Doesn't mean you shouldn't get it. Mo, why is it tax inefficient?
Double taxed.
You are double taxed. This is a big beef of mine that I'm going to get into. When you see a company have a net income on their profit and loss statement, that net income is after taxes. Let me show you in our software. So let's pull up a company like Microsoft. Microsoft, let's go to their income statement. And if you look right here, net income of $67.45 billion, right? Provision for income taxes was 15. Their pre-tax income was 82. So they've already paid taxes. Then they're going to take the $67.5 billion and give you money. And then guess what's going to happen?
You're getting taxed.
You're getting taxed on that. In my business upstairs, it's all LLC. I just pay my one income tax based on my income. It's all passed through based on my pre-tax income. And then I pay taxes on it. So whenever people tell me like, oh, we gotta tax dividends because it's free money. No, it's not. It's not free money. It's already been taxed. It is double taxation. So it's tax inefficient. If they're paying 35%, whatever the number is here, this is like 20% here, and we pay 30%, that's 100 down to $80, and then 30% of that is minus 24, so that's $56. You've paid 44% in taxes. Yep. 44% in taxes.
No bueno.
No bueno. Now, what are the benefits of dividend investing? Why would a company issue dividends, Mo?
They need something to do with their cash. And in a lot of cases, that's a way to attract investors to their stock.
So first off, they're going to do it to attract people to their stock because people love dividends. So they're going to say, listen, now, one thing I want you to remember though, is I want you to, this is what we have. This is why we have this in our software. We put the dividends paid right here on the main page of the software. This is Microsoft. And right above it is the free cash flow. Don't fall into believing that the dividends that are being paid at dividend rate is secure. It could very well not be. Me personally, I want to find a company that pays less than 50% of its 5 years free cash flow in dividends. So the 5-year average free cash flow for Microsoft was $48 billion. They're paying out 19. That is less than half. I'm okay with that. That is okay for me. But there are companies out there where I'll sit there and go, how are they affording this dividend? Mm-hmm. Now, another reason a company might issue a large dividend is they have nothing else to do with the money. If a company has no other reinvestment opportunities, they got to deploy the cash somehow. And the best way to do it is buy back cheap shares or issue dividends because people like dividends.
And in a lot of cases, they buy back expensive shares and pay a dividend.
So I just saw some tweet the other day. Somebody on Twitter tagged Elon Musk. Hey, with that $22 billion in cash Tesla has, how about buying back some shares? And I literally just repeatedly hit myself on the head repeatedly. I'd much rather have Tesla issue a dividend,
yep,
than buy back their shares at the current valuation. Yep. Much rather. And dividends can be attractive, especially as you get older. If you have a nice dividend, there's a rule of 4% where you should live off 4% of your bank account, off your savings. Well, if you can find a dividend portfolio at some point in the future that pays 4%, then you can live off that. Now, what is the S&P 500 right now paying? It is currently 1.64 as of January 27, 2023. So 1.64%. Now, that's not a lot, right? However, for those of you who've watched our channel before, this is my stock market to GDP ratio. And we're currently 70% overvalued. So if we fell to fair value, 2,400, what would that take the dividend yield to? 1.64 times 1.7 for 70%. It would take it to 2.8%. So then you weed out the non-dividend paying stocks. Yep. You're at 4% probably. Mm-hmm. Because there are a lot of stocks in the S&P 500 that don't pay a dividend. I know that was a lot to handle, and please rewind. But the bottom line, what I said was, we're currently overpriced big time. And I hope this doesn't intimidate you, but if you watch more videos, I guarantee you will understand it better and better. I was in the same boat as you 20 years ago. This stuff was over my head, and slowly but surely, I just learned. I read a little bit more, and you have the benefit of having videos to watch. We have over 2,000 videos in our channel. Go ahead.
You go ahead.
So if stocks fall to where they should, the dividend yield will go higher because dividend is dividends. Dividend yield is dividend divided by price. This is probably going to stay very similar. And if this goes down, your yield goes up and you can make more and more money off your money.
Right.
I created the software that you're seeing on the video and behind me because I needed software for myself. This is not something that was created for other people and I use some super exclusive, expensive software. This is the software I use. And even better, we have this community of thousands of people there. And the reason it's so helpful is it allows us to eliminate the emotional fear that makes people make the bad decision in investing. The right investing is 20% about the numbers and 80 or 90% about your temperament and emotion. And that's why it's awesome to have this community. The tools help you on the numbers. The community helps you on how to view your investments and your money. So stop making those terrible decisions that all your idiot friends make when they follow companies just because they like the company. For a little over $1 a day, you can have this entire software package. It'll change your entire future of investing and your money. So sign up now, risk-free, everythingmoney.com. Check it out.
Something that a lot of people do is they just invest in a company for the dividend.
That's a big mistake.
Exactly. So like this is a good example. It's at&t. Now, at&t, if any of you have watched our videos, we're avoiding it just because they're in a restructuring phase. There's a lot of debt. There's a lot of issues. But right now they pay a 5.5% dividend. That looks very attractive. And I use this analogy all the time.
But I will say one thing.
Go ahead.
Look at their dividend yield currently versus last 1 year's free cash flow.
I know.
So 11.6 billion.
11.6 billion versus 13.1 billion.
Now, I said I want to look at the 5-year average, but remember with AT&T, they spun off a lot of businesses in the last year. So that 5-year average free cash flow is not to be trusted.
And you can see their previous dividend was 8.12, it's down to 5.5. So, but this is the same thing. When you go and buy a bad company or a company that you don't understand, you're going to the ice cream store, you're getting an ice cream sundae and you're putting all the ice cream in it. Then you're putting the frosting on top of it and you put the sprinkles on there and then you get the cherry on top. And this is the dividend. You are buying the stock. You are buying the ice cream sundae to get the cherry. Just go and buy the cherries. Go and find good companies. Don't buy ice cream sundaes to get cherries. It's going to hurt you.
Yeah, so Mo's main focus, I love the analogy, is just go out there and find good. There are plenty of great companies out there that pay a good dividend. But if you're young, you should want to find companies that are able to compound their money and not paying a dividend. Yeah. Because if they compound their money by reinvesting back in themselves, you don't have to pay tax on that money. It's going to keep building on itself. If they have a high return on invested capital, they can keep driving up more and more of their net income at higher levels. If they drive up the net income at higher levels, they're doing you a favor because they're driving that earnings per share, which will make your stock value go higher. That's what you should be worried about. Now, with that said, Mo, do you like dividends?
I love them.
I love dividends. Warren Buffett loves dividends. We all like getting a check.
I'm not going to complain about getting a dividend.
I will only complain if I'm like, why are you guys paying a dividend when you have other areas of which to? It's, to me, dividends should be reserved for companies who go, we have nothing else to invest in. Here's money back.
Yep. Have fun.
Great. That's when they talk about returning money to investors.
Yes.
So dividend investing is absolutely important, but it's important for the right framework of which you're trying to accomplish. If you're young and trying to get high returns down the road, don't look for dividend yield investing. Now, it doesn't matter. It doesn't mean you shouldn't have dividends. However, if you're going to invest in a company that pays dividends, make sure it's super, super cheap. Super cheap. Where they're going to, and even then, I'd be looking at the company going, stop paying dividends, buy back shares. That's the better way to return money to your investors. I appreciate your time.